Okay, this one actually matters for your bank account. If you've got money sitting in savings, if you're carrying a credit card balance, or if you're even thinking about buying a house in the next 6 months, what the Fed does in September is going to cost you money or make you money. Thousands of dollars either way. 4 or 5 meetings in a row this year. The Fed's basically said the same thing. Holding steady. No hike, no cut, just wait. That just changed. Monday, Bank of America and Deutsche Bank, 2 massive banks, quietly flipped their entire forecast. They're now saying the Fed will raise rates in September. And not just once. 3 times before the year's out. So what does that actually mean for you? Your high-yield savings account, sitting at 4.5% right now, could climb toward 5%. That part's good. Here's the part that isn't. Your credit card, already at 22.5%, creeps toward 24%. And that mortgage rate that just dipped to 6.76% this week? It could jump back above 7.5%. Over the next 15 minutes, I'm going to walk you through what's actually happening here, why the Fed is even considering this, and the 3 moves you need to make before September 1st to protect yourself. Stick around for move number 2, though. That one alone could save you over $2,600 this year. Let's strip out the economics textbook language and just talk plainly. The Federal Reserve is basically the landlord of money in America. They set the price of borrowing. That price has a name, the federal funds rate, and right now it sits between 5.25% and 5.5%. Here's why that touches your life. When the Fed pushes that number up, every bank follows. Your Chase credit card, your Wells Fargo mortgage, that car loan through Capital One. All of it gets more expensive. Why'd they push it up in the first place? Inflation. Back in 2022 and 2023, prices went a little insane. Eggs, rent, everything. So the Fed's logic was simple. Make borrowing expensive, people spend less, prices cool off. It worked, sort of. But now, in 2026, a new wrinkle has shown up. Inflation's creeping back. Not because people are spending too much, but because oil prices are climbing again with everything going on in the Middle East. America still imports a lot of oil, so when it goes up, gas goes up, shipping goes up, and yeah, your grocery bill goes up too. On top of that, the job market's still stubbornly strong. The jobs report dropping August 7th is expected to come in hot. And a strong job market, ironically, tends to push inflation the wrong direction too. More people working means more people spending. So here's the interesting bit. At last month's meeting, 3 Fed officials actually pushed for a rate hike right then. They got outvoted, but the fact that they wanted it tells you something. And now Bank of America's out there saying, expect a hike in September, another in October, another in December. That's the most aggressive call on Wall Street right now. Even the traders agree. The CME FedWatch tool is showing a 68% chance of a September hike. A quarter-point hike sounds small, right? Let me show you how a small number like that quietly pulls thousands of dollars out of your pocket. If you're someone who actually saves money, pay attention here, because this might be the best window in 15 years to just have cash sitting around. As of August 3rd, the top high-yield savings accounts are paying up to 4.5% APY. That's annual percentage yield, basically what your money earns you in a year. For context, back in 2021, the big banks, Chase, Bank of America, Wells Fargo, were paying you 0.01%. You could park $10,000 there for a full year and walk away with $1. $1. Now compare that to online banks like Marcus, Ally, or American Express Personal Savings, sitting around 4.5%. Let's put real numbers on it. Say you've got a $5,000 emergency fund. At 0.01%, that earns you 50 cents a year. At 4.5%, that's $225. For doing absolutely nothing. Got $10,000 sitting there? At 4.5%, that's $450 a year. And if the Fed does push rates up to 4.75% or 5% in September, that same $10,000 could earn you $500. That's a free flight. Or 2 months of groceries. Just from interest you were probably leaving on the table. So here's what I'd actually do. First, stop keeping your emergency fund in a regular checking account. Big banks are quietly taking advantage of you here. They take your money, lend it back out at 7%, and hand you 0.01% in return. Second, don't lock your money into a 12-month CD right now. I know plenty of finance YouTubers are pushing lock in 5% today. I'd actually hold off. If the Fed hikes in September, October, and December like predicted, savings rates keep climbing. You want your money staying flexible in a high-yield account, so your rate rises automatically with the market, not stuck at today's number. Third, just double-check your account is FDIC insured up to $250,000. Every bank I'll link below meets that. I'll drop a comparison of my top 3 picks in the description. Now, the part nobody enjoys hearing. If you're carrying debt, a rate hike is basically a direct tax on you. Let's break this into 3 buckets. Credit cards first, because this is the dangerous one. The average credit card APR right now sits at 22.51%. Already brutal. If you're carrying the average American balance, about $6,000, you're paying roughly $1,350 a year in interest alone, just to exist. When the Fed raises rates, your card doesn't wait around. It adjusts within your next billing cycle, usually inside 30 days. So that 22.51% creeps to 22.76% after one hike. Doesn't sound like much, maybe $15 a year on $6,000. But stack 3 hikes together, like Buffett's predicting, and that's closer to $45 a year extra, for nothing, on top of what you're already paying. And if you're only making minimum payments, you could be looking at 18 years to actually pay that off. Mortgages are the big one though. As of August 5th, the average 30-year fixed sits at 6.76%. It actually dipped a bit this week because people assumed the Fed was finished hiking. Here's the catch. Mortgage rates don't track the Fed's actual moves so much as they track what the Fed says. If the tone turns hawkish, mortgage rates jump almost immediately before any official hike even happens. Economists at Fannie Mae are now saying mortgage rates could climb back to 7.25%, maybe 7.5% by October. Let me actually run the math, because this one surprised me too. Say you're buying a $400,000 house, putting 20% down. Your loan's $320,000. At 6.76%, you're paying about $2,079 a month. At 7.5%, that's $2,237 a month. That's $158 more every single month for 30 years. Add it up, and that's nearly $1,900 extra a year. Over the life of the loan, close to $57,000 in extra interest. Just from waiting 2 months. Auto loans and personal loans move too. New car loans average around 7.1% right now. After a hike, that could tick up to 7.5% or 7.8%. On a $30,000 car, that's roughly $30 more a month. So what do you actually do before September? If you're carrying credit card debt, treat it like an emergency. Pause investing for a couple months if you need to, and throw everything you can at that balance. Highest interest rate first, the avalanche method. If you're house or car hunting, talk to a lender this week. A lot of them will let you lock a rate for 60 to 90 days at no cost. Lock in that 6.76% now, before it potentially climbs back up. I know what a lot of you are thinking. Okay, but what about my 401k? My Roth IRA? My Robinhood account? Here's a pattern that's held true for about a century on Wall Street. When rates go up, stocks get nervous, especially growth and tech names. Think about it from a company's side. Say you're Nvidia or Tesla. You're borrowing billions to build factories, fund research. If borrowing suddenly costs more, your future profits look thinner on paper, so investors start selling. We actually saw a version of this play out in July, with hedge funds taking losses on tech trades, according to JP Morgan. Money tends to rotate out of risky tech and into safer stuff, like a savings account paying 4.5%. Should you sell everything and run? No. Honestly, that's the classic beginner mistake. Historically, every time the Feds hiked rates, markets dipped for 3 to 6 months, and then recovered, usually hitting new highs within about a year. If you're in your 20s, 30s, even 40s, a dip like this is basically a discount. Black Friday, but for stocks. What smart investors actually do here is pretty boring, honestly. They keep their automatic investments running, still dropping $100, $200 a month into an index fund. That's dollar cost averaging, and when prices dip, that same money just buys more shares. They keep 3 to 6 months of expenses sitting in that high-yield savings account we already talked about, so they're never forced to sell stocks at a bad time just to cover an emergency. And they steer clear of loading up on pricey and profitable tech stocks right before a hike. If you've got a 401k through work, honestly, just leave it alone. Don't even check it. Keep grabbing your company match. That part's free money, no matter what rates do. All right, let's cut the theory and make this actually useful. Here's exactly what to do this week, before the September meeting. Move 1. This weekend, if you don't already have a high-yield savings account, open one and move your emergency fund over. Already have one? Make sure it's paying at least 4.3%. Anything under 4%, you're leaving money behind. Links to my picks are below. Move 2. Go after your bad debt. List your cards highest interest first. Minimum payments on everything, but throw every extra dollar you can at that top card. If the Fed hikes 3 times like predicted, that debt only gets more expensive the longer it sits. Move 3. If you're shopping for a house or a car, get pre-approved and lock your rate now. Talk to a couple of lenders, not just one. And for your investments, just automate it and try not to watch the news too closely. The Fed's job is managing inflation for the whole country. Your job is managing it for your own household. If this actually made things clearer, hit like. It helps this reach other people just as confused about rates as you probably were 5 minutes ago. Quick question for you. Drop it in the comments. Do you think the Fed should raise rates in September? Yes if you think they need to keep fighting inflation. No if you think they should leave things alone. I read these, and I'll reply to the first 100. And if you want the actual breakdown of which savings accounts are paying that 4.5% right now, I've got a video comparing the top 5, no fees, right here. Thanks for watching. See you in the next one, and let's keep your money protected together.